Hang Seng is higher by around 0.7%.
We have inflation, which is clearly rolling over and on its way down.
Hindustan Zinc is under pressure. There are a couple of factors that played out. Results were in line. They declared a dividend of close to around 13 rupees.
That's the first tick on the index, slightly subdued, down about 20 odd points.
Higher yields, lower price earning multiples. And if that's going to be the case, I think that dictates the course for 2023.
We got the verbal order from the NCLT Mumbai bench on 12th of January. We are waiting for a certified true copy of the order.
We've always said that our ROAs will be in the range of 1.8 to 2.2%. And I think we are in that range. You should see that moving up gradually.
We opened in the red. Since then, we managed to pull back. We are trading in the green. But again, in the last 10 minutes, we have come off from the day's high.
The quarter was tough, as we know that, because of the price increase base, which was quite phenomenal.
A very large proportion of that have come out of this partnership, which means designed, developed, made and sold out of India.
This is the mid-cap index, which is underperforming today. That one is down 104 points as we speak.
Well, that was a day so far. You're with us here on Closing Bell this Friday afternoon. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima and Nigel, as always. Guys, hi, good afternoon. Last hour before Nigel goes to party.
Actually called to JSW Steel this time.
But after that, I meant. Anyway, things are looking a little iffy, and they've become a little iffy in the last, 30-40 minutes or so of trade. You got, actually, till about, 1:30 or so, the market was okay. After that, we were at about 18,100. Since then, we've kind of slipped about 50-60 odd points very quickly. So this is now a 65 odd point cut. For the bulk of the day, the index was not doing very much at all. It was a very flat day, but now it's a more definitive kind of a move. I won't get too much into Nifty. The big thing is that the trend reversal level, which we put out in the morning also, is 17,853. It's a clean 200 points away from where we are trading right now. So it's got some distance between where that level is and where we are now. So that's about it. I mean, that's the level which should sort of defend itself. In any case, we've been battling these ranges, and I don't think, today is going to see a big break one way or the other. I think where there is a fair bit of focus and worry which is emerging is earnings cuts which are emerging across a range of consumer companies. Now, these are typically kind of described as growth companies, generally high valuation, years of secular growth, etc., those kind of things. And on a range of companies, we've seen earnings cuts. So Havells, I just picked out, I mean, this is not Bloomberg consensus, but just one broker and what they've done post-earnings, which each of these reported over the last 48 hours. Havells, for example, Kotak has taken down their estimates by between 5 and 8%. Asian Paints is another one where Kotak has cut their estimates between 23 and 25 by between 3 and 5%. There is HUL, where Kotak has cut their FY24 and 25 earnings per share estimates by between 2 and 3%. And you look at something like a LTTS, right? L&T Technology Services, where the company itself has lowered its revenue growth guidance so as to speak. PVR is another one. I mean, again, there are no earnings cuts, but there was that note from Kotak recently. We had the management with us in the morning where they highlighted in a way that they're going to kind of expand and diversify more, even as they see a lineup of strong Bollywood releases this year. But the worry is that Bollywood's tepid showing is going to make a dent into PVR's earnings if it continues. So, the earnings revisions where there are earnings revisions by the street are not massive. But the point is, these are not stocks which are priced with some buffer that, earnings can come in line or they can even go lower. These are stocks which are trading much above pre-COVID levels. And of course, I mean, much higher as compared to their, say, 10 or 12, 15-year average PE multiple. So that's the problem in this part of the market where there is a fair bit of pressure which is coming through. So, and we'll discuss that with guests as well over the next hour. Rima, hi.
Hi, and markets have been grinding lower, right? The high today was hit around 1040, thereabout, and since then, we've lost about 120 points in the Nifty, and the Nifty currently is above 18,000, but it's 82 points lower, 18,025 on the Nifty. As Prashant pointed out, it's the FMCG index which is under pressure for the second day in a row. So that's buckling under the weight of Asian Paints, HUL, Nestle. For Asian Paints, of course, there was a big miss in numbers, and that's the reason why for the second day in a row, you are seeing big cuts. Softness in JSW Steel and Reliance ahead of numbers. So pull up the intraday chart, and you would see both those stocks inching lower and lower. Banks continue to hold forth. The Nifty Bank is outperforming today by a big margin. The Nifty Bank is still up 0.5%. It's come off a bit from the day's high, but courtesy HDFC Bank as well as HDFC Limited, which have rallied 4% this week, HDFC Bank has been solid. A couple of the other big movers include Coal India, risen for the third day in a row. Tata Motors, there is buzz about some EV fundraise. So Tata Motors has been active in trade. Today, after 7 continuous days of a gain, IT has started softening. Pull up that intraday chart of Nifty IT, and in the last 1 hour, the biggest cut has actually come in on the Nifty IT index. And finally, after a very good run of good earnings, today you've had weakness in Emphasis and L&T Tech. So now the street is, sitting up and taking notice that it's not up and away for Nifty IT. You are going to get those roadblocks, hiccups along the way after the misses coming in from 2 of the numbers, Emphasis as well as L&T Technology. Our team is just pulling up the week-to-date performance, and that will come up for you on your screen. The Nifty is down 0.5%. The mid-cap index is up close to about 0.5% for this entire week. But Nigel, what are you tracking?
Well, Rima, the Nifty Bank, you just spoken about that. That's on its way to its 20 DMA. It's just around 20 points away from out there. So we'd like it to close above these levels because that's the bit of an underperforming space, for the last few weeks. And that seems to be getting its mojo back. So the Nifty Bank is important. You'd like it to close above the 20 DMA. It's only around 20-30 points away from those levels. Keep an eye out on that. Earlier today, the big call was that maybe, in fact, IT will underperform. And it appears that's played out because the IT index is down close to around 0.4%, and it's dragging the index along with a couple of other names as well, Reliance Industries and HUL. Now, the high point of today was around 18,150. So Nifty went to that level and then, in fact, corrected close to around 120 points odd. But we're at a very crucial juncture because the 18,100 call has been written with gay abandon all through the trading session. Very, very aggressive writing being seen out there. And I'm viewing that 18,250 to 18,300 as a very, very firm resistance out there. So let's see whether or not at any point of time, if we get some good news, whether we can get past that. But that's a big resistance zone. On the downside, we're at the lower end of the band. And that 18,100 put was seeing a lot of open interest addition. The premiums are around 100 rupees. So that 18,000 mark, you'll want to conquer that on a closing basis. That's going to be very, very important. One of the focal points out there. Reliance Industries is dragging its feet. So let's see how this one plays out. But from a bullish perspective, you want to defend that 18,000 odd mark. Rima?
Okay, for now, we're holding on to it. Let's see whether it can hold in the last 1 hour. By the way, European markets have opened up firm, and they are trading with gains of close to about 0.5%. The CAC, DAX, and the FTSE, all 3 of them currently up 0.5%. No pressure coming in from the European region, at least. Let's tell you what we've lined up on the show then. Union Bank and HDFC Life will be in focus on the back of their quarterly updates. A complete earnings fine print coming up on the show. Coforge is buzzing in trade on the back of a strong Q3. Key excerpts from our conversation with the management also on closing bell. In key earnings to track today and tomorrow, we'll get you expectations from big boy Reliance Industries, JSW Steel, ICICI Bank and Kotak Mahindra Bank. And finally, we'll be joined by our Alpha Manager for the day, Anand Shah of ICICI Pru AMC, to discuss his top portfolio bets.
Well, what you should be doing in the last 60 minutes is something which Mitesh tells you at 2:30, and he's with us. Mitesh, hi, good afternoon. Good to have you with us here as always. So there's a leg down, which is, it's expanding now. 85 points on the index, 18,025. What would you do?
Yeah. Good afternoon, Prashant. So I think the belief is that given this idea of, markets failing to sustain at higher levels and again tapering off, and as you rightly pointed out, it was expanding mildly on the downside. I think the possibility is that we could be again heading towards the lower end of the range. So there's some mild pivot at 18,000 levels, but I think good chance that 17,870 or 17,800 levels could be revisited. So in that sense, I think we are still in that range, but now possibly starting a journey on the negative side. I have a sell call on Power Finance Corporation with the stop at 153.5. Look for targets of roughly around 144 to about 143 on the downside over here. While Power Grid is a buy, keep a stop at about 220.5 and a target of 230 can be looked at.
Okay, all right. Thanks a lot for that, Mitesh. We'll keep coming back to you through the next 60 minutes. We're getting a lot of numbers that are coming in. Then Union Bank, that's in focus on the back of the quarter 3 numbers. Abhishek is joining us to slice those numbers for us. Abhishek, how about the numbers?
Well, Nigel, to begin with, the net interest margin and return ratios are perhaps the best in last 32 quarters or 8 years or even more. So, net interest margin has come in at 3.21%, which compares to 3.15% in the previous quarter. The ROA or return on asset is at 0.73%. Perhaps for the first time that I am seeing a 0.65% level above ROA in last 32 quarters, and ROE that has crossed around a 14.5% level. So that is also very strong. Asset quality, one of the best in last 7 years. Annualized slippage ratio is at 7-quarter low of just 2.38%. Gross NPA ratio is at 7.93%, one of the lowest that you are seeing in 28 quarters. And net NPA ratio is at 2.14%, perhaps the lowest in 32 quarters or even more. So PNL, the NII growth is really strong, up about 20.3% YOY and close to 4% sequentially. The annualized credit cost, that's also heartening to see. It has come in at just 1.22% when compared to around 1.5% in the previous quarter, or it's the lowest in last 7 years as well. So PAT, on account of strong top line growth and control over credit cost, has increased by 107% YOY and about 21.5% sequentially. Talking about business momentum, deposits are up 13.5% YOY and 2% sequentially. Loan growth pretty robust YOY, more than 20% YOY and around 4% sequentially. Back to you.
Okay, numbers looking pretty good. Abhishek telling us that. But the market texture is not all that great, and that's weighing on everything. Prakash Diwan is with us to take some questions. Prakash, good to have you with us here. Good afternoon. I mentioned these earnings cuts which are coming through in these consumer names. Havells, Asian Paints, Lever, PVR, of course, from the IT space, maybe L&T Technology Services. Any thoughts? What's going on?
So I think, good afternoon, Prashant. So I think very clearly the market's kind of in that state of uncertainty, and result season always brings this anxiety and uncertainty around, especially when the sector leaders or representatives or the proxies to the sector come up with numbers. So if Asian Paints is going to report numbers that are not so encouraging, and with such a massive PE expansion that's already happened in the last couple of years, there's always room for some sort of a PE contraction or rationalization. So it's nothing very unusual. And the same thing will go for some of the larger names like HUL and all. It's very clear there is a little bit of demand contraction. While input prices have come down, their inability to increase volumes immediately in this quarter and the next is going to definitely weigh heavily down on them. And when money is being pulled out of the large cap names via the ETF routes or even from the actively managed funds, you will see a little bit of a collateral damage in terms of the kind of selling that you will see in some of the heavy-weighted counters. So I'm not surprised. And the market probably till the budget is going to be range-bound, but with this kind of a bias where anything negative on the earnings or slightly disappointing is going to get punished. So you could probably see that happen as a sector rotation every day when there's a large player. So tomorrow you've got ICICI Bank and Kotak coming up with numbers. And if the numbers are good, probably banking gets a leg up on Monday. But so those kind of things will keep on happening. Great time to relook at your portfolio from a slightly medium to long-term perspective. And if you feel you're not aligned to the sectors that are looking promising and you're underweight, probably do that shift during this time before the budget is my sense.
Your thoughts on HUL? There is that additional royalty which has been announced, but considering that profitability for HUL has not been so bad, do you think they will be able to absorb this increased royalty, or perhaps through cost efficiencies? And considering they've been gaining market share, do you think this dip that we are seeing is a good buying opportunity, or would you wait it out?
Good afternoon, Rima. So I think the dip is the start of a little bit of a softness that could prevail for slightly longer. The trigger could have been probably the additional burden on the royalties. But remember, the kind of acquisitions that HUL has been making in the recent past, they've given a very different dimension to the portfolio. They're no more depending on those low price, SKUs for their volume growth. There's a very significant shift in gears in terms of getting into the higher end or higher price points of their product lines. And that is something, Rima, very clearly, which is going to start benefiting them probably towards the second half of calendar 23. And the cost rationalization and efficiencies that they started off early last year, middle of last year, when crude was at its peak and packaging costs, logistics costs were really hurting, those benefits will continue to be there because the processes have got rationalized, have got more efficient. But you really don't reduce prices just because things get more better or efficient on that one. So that will also work. I think it's a good buy at lower levels for sure. But don't jump at it just because it was soft for a couple of days. You'll probably get better days to buy into the consumption pack or specifically the large cap FMCG names.
Just one point about that HUL premiumization and how it's been boosting margins. Prashant, in FY21, HUL's margins were 14%. FY23, margin 16% for the full year. FY16, margins of 18%. And now last year it ended with margins of 25%, which basically means in the last 11, 12 years, margins have gone up from 14% now to 25%, right? That's a significant expansion in the company's profitability. So that's why I asked, right, that now maybe it has within them to absorb this increased royalty because they are focusing so much on premiumization that maybe they will be able to
What
absorb.
was the starting point, Rima? You said?
March
13.
11. So FY11, it was about 14%.
I see.
And now we're at 23, 25%.
I'm just asking that because the big re-rating in lever coincides exactly with this phase, right? So it was flat from 2000 to almost 2010. 10 years it did nothing. That famous no return period for HUL. And then it started in 2010. To 2010 it closed at 312 rupees. And over the next 10 years, exactly the next 10 years, it went up 10 times. So the performance kind of mirrored that, and I think that is in a way the recency bias, right? A lot of people think that it's made money, it's compounded money nicely over the last 10 years, so this is perhaps the place to be in a way, but valuations are much richer as compared to, and I will present a piece later at 4:30 on Editors Roundtable on this, compared to average P multiples compared to pre-COVID, a lot of these names very, very rich in that sense. We'll take a quick commercial break here. We'll be joined by our Alpha Manager, Anand Shah of ICICI Pru AMC to discuss.
Welcome back. It went down to levels of 18,025. It's climbed back, clawed back to 18,050. So in the last 10 minutes, you can see a tick up on the markets now. Still down 60 odd points. But again, there has been a bit of a leg up in the markets. Apollo Hospitals is inched up a tad bit. Again, it's not a big up move, so you really can't see it in individual names as well. But let's talk about Atul Auto. Came out with their Q3 numbers. Looks like a miss. Sonal is here with the fine print. Sonal.
Well, it's Atul Limited that reported numbers a while back, and it was a miss, of course. The numbers were much lower than what the street was working with, and slowing demand and fall in price is something that impacted revenues this time around, and the margin miss really came in because of performance and other chemicals. So if we look at the overall numbers, revenues declined 9% on a YOY basis. Even on a sequential basis, it is a decline. EBITDA declined by 31%. Margins took a hit of almost 500 basis points. The expectation was of margins of around 15%. The margins have come in at 13.6%. Profits are also down by 34%. Now, as I said, between the two segments, it was performance and other chemicals that did not do so well. But life science chemicals, performance and others, which is actually the smaller part in terms of revenues, there the revenues grew by 24%. In performance chemicals, it was down 19%. Even in terms of margins, the performance and other chemicals took a big hit. Margins there came in at 3% versus 14% on a YOY basis. That is the segmental EBIT. And in life sciences chemicals, it was at 22% versus 11%. So there is where we saw a margin improvement as well. The stock is also not very cheap. Trades at 35 times FY24 EPS, is down 10% year to date so far. And the weakness in pricing and demand is something that continues to impact the stock price as well.
Got it. Thanks a lot for that. So now when the stock trades at more than 35 times and you have margins getting compressed by close to 500 basis points, explains why the stock is taking a bit of a knock. Prakash, what's your view on Atul? The stock is down now. It's seen a sharp dip post its numbers.
Oh, absolutely. You said it, Nigel. I think this is exactly what I was alluding to a couple of weeks back when indications were very clear that the slowdown in Europe is hurting all of these specialty chemical names because there's absolutely no demand. It's so tepid that some of them are actually going to be finding it extremely difficult to report any improvement in revenue or margins. But the side effect of this entire situation is that those who survive this slowdown and have stronger balance sheets are the ones that could probably resurrect themselves. A lot of the smaller marginal players would, on the fringes, would probably get wiped out if this extends a bit. So it's a big what do you call a shakeout phase of sorts for the chemical names. But the likes of Atul, Aarti, Deepak, SRF, they have their niches which they've developed so well, and they have strength on the balance sheet to sustain this slowdown. But it is a reality that issues related to raw materials have now, on the supply side, have now actually been substituted by issues on the demand side. So it's time to relook at some of these names and probably re-enter at lower levels if you don't have the heart to see this volatility on the way down.
The market's been up and down. While we've been talking about individual stocks, we were down 85. There was a sharp recovery, and that has also now been kind of sold into at this point in time. There's this name called Hariom Pipes, I think, which is buzzing. It's up to some 12-13%. Prakash, have you looked at this? Have you tracked it?
Oh yes, I think it's one of those few names last year which did well after the IPO and sustained at those levels. And they did an acquisition recently, which is really helped them expand their book. So it's everything's kind of falling in place in terms of what they promised at the time of the IPO, Prashant. And remember, as you get closer to 2024, which is the election year, there is going to be a huge impetus on something which makes a big difference to people in the country, and that's going to be the Har Nal Se Jal Yojana. If that is to be a reality, all your pipe players, especially the ones that are part of this entire network build-up, are going to benefit. Hariom notwithstanding. So you will see that secular change in outlook for these companies, and the softness in raw material costs has also probably been helpful in terms of managing the margins to go back to what the levels that they were comfortably prevailing at. So all of that's kind of been it. It's a good company, well run, smart management, runs a tight ship, but it's a small company, so you need to kind of take it in your stride.
There is this other mission also, Jal Jeevan. That's also driving a lot of sales for pipes companies. I think we were talking to a company called High Tech, and they had indicated that Jal Jeevan is driving volumes for them. But Prakash, thank you very much for that. Let's talk about Chris Wood of Jefferies, who's introduced an investment in Godrej Properties in his Asia ex-Japan long-only portfolio. Vivek is here with the highlights.
Well, that's right. A very interesting note coming in from Chris Wood of Jefferies. The strategist there actually has made quite a few changes in his much well-tracked greed and fear portfolio. So, what he's done today is that the first thing he's done is he's actually gone ahead and replaced ICICI Pru Life in his long-only portfolio, and he's replaced it with HDFC Life. And as you mentioned, he's introduced a fresh investment in Godrej Properties with a 3% weightage, and this particular weightage is at the expense of macrotech developers. Now, what we've actually done is we've seen some of his recent recommendations. In fact, we've seen his most recent recommendations and how exactly had the stock prices performed post his recommendation. So on December 22 of last year, he actually made some changes in his long-only equity portfolio. He actually reduced the weightage in Bajaj Finance, but he made an interesting investment in REC with a 4% weightage, and 1% weightage each were reduced from, as I mentioned earlier, Bajaj Finance, HDFC Bank, ICICI Prudential Life, and ICICI Lombard. And if you look at the stock performance, clearly there's been an outperformance in his recommendations. REC moved up almost 10% since then. Bajaj Finance and ICICI Lombard clear, laggards, -9% and a 7% decline seen in both of them. He's also quite long as far as the PSU basket is concerned. So he has a significant weightage in ONGC, 10% weightage there. SBI has 6% weightage. REC, 4% weightage that he introduced last time. And Concor, again, a 4% weightage there.
Right. Thank you very much, Vivek, for that. Appreciate it very much. Just put up this stock, this stock called Nureka. That is NURECA. It's up. It's limit up, by the way. It's up, I think, 20% or so, 402. We'll try and have more on this one for you. I think, I don't want to be completely wrong here, but there's a medical devices company called Dr. Trust. That is housed in this business, in this company, Nureka Limited. Doesn't come up on the screen very often. It's had a one-way slide. looking at a long-term kind of chart, the high was in 2021. Actually, yeah, October of 2021 was at about 2280. It sold off all the way. It made a low today, by the way, all-time low at 315 today, and then it's bounced very sharply in terms of trade, the daily trade from yesterday's close. More on this later. Anand Shah is head of PMS and AIF investments at ICICI Prudential Asset Management Company. He's joining us to take some questions. Anand, great to have you with us here. Thank you very much for your time. What are you making of the earnings which are coming through? You own any of these names? Asian Paints, Havells, PVR, Lever, for example. These are numbers in the last 24, 48 hours. And mostly we are seeing earnings estimates, future earnings estimates being slightly brought lower. Your thoughts?
Hi, very good afternoon. Thank you for having me. Yes, you're right. And, generally the discretionary spends was a little bit under pressure this quarter. The way we are seeing earnings season so far that we have seen, I think it's largely in line with expectation. What is changing is, the future expectations are being sort of subdued, and very high valuations on these companies, which was pricing in a lot more in terms of growth and margins. There we are getting some confirmations, but that, it's not to be. And that's when, a little bit of a, what would I say, a negative on that. But otherwise on banking, we are seeing fairly decent numbers in line with expectations again. On IT, again, numbers are decent. So, yeah, more or less in line with expectations. That's where
All right. Hi, Anand. I was looking at your performance of the fund in comparison to some of your peer group, and you all did quite well in 2022. So congratulations on that front, particularly with regard to the broader markets. Anand, I'm just looking at your portfolio construct, and it appears you all in the camp that believes that metals could have some more way to go. You'll have stocks like SAIL in various portfolios, you have Godavari Power and Ispat, and a couple of other names as well. Could you correct us then? Could you tell us, do you believe that some of these metal stocks, they still have some legs to go from here on, given that China's reopening?
Yeah, I think the broader market's been very bipolar. So our 2022 performance has been not owning IT, not owning pharmaceuticals, owning a lot of manufacturing and manufacturing allied, which includes even the corporate banks that have been sort of supporting our view and supporting the fund performance. Coming to metals is one part of the manufacturing leg that we believe would structurally benefit. And again, not unique to metals, but if you go back into the history, last 10, 12 years been very tough for the sector from a macro perspective, and even micro perspective. The businesses had done acquisitions, leverage, run up to the 2007. So I think a lot of cleanup, a lot of restructurings have been done in these businesses over the last 12, 15 years. Balance sheets are now far more stronger. But the good news in terms of tailwinds would be growth in manufacturing in India, which would create demand for metal in India, but also the oversupply situation, which been hurting global metal stocks emerging out of China. That's been, again, expectation is that that's behind us. The pollution clampdown in China will, and obviously the rising cost in China would make sure that they will not be incrementally a large exporter of metal. And even the policy level also, the government doesn't want a large exporter of metals.
Anand, you said that you outperformed the markets by completely avoiding IT in 2022. What's the call on IT big picture for 2023?
So again, long-term and short-term. Long-term, obviously, these are very high-quality businesses, and they would do well. But nevertheless, what happened in 2021, they had, relative to the rest of the market, they had better results, better earnings, a good growth prospect. So not only their EPS did well, but the market re-rated them very well. However, with the economy opening up, the IT budgets are not growing as fast as they were growing because the companies, the clients are also spending more on non-IT. Similarly, the costs are going up. We all are well aware of what's happening on the manpower cost in particular, which again seems to have peaked out. So I think it's more of a short term. We believe beginning of this year, the valuations were expecting something. The street was expecting something. The reality was something different. I think market is coming around and understanding that, the times are getting tougher for these businesses. And to that extent, we have seen a reasonable de-rating. We believe there's some more legs maybe, but we are watching that space.
Watching that space closely. The in your top holdings, there is no real export presence, right? Anand, that's the big kind of takeaway. Or am I wrong in reading the list?
No, so we are
no
very
significant export list. Yeah.
Yeah, so we've been sort of constructive on manufacturing exports. Not that we are, IT services growth will also continue, but I think that is something not new, and to that extent, market have factored in a lot of, growth that we would see in IT services. But manufacturing exports is something, again, we believe structurally should improve from here. I think a lot of efforts been made on that front. We've been also talking about China +1, Europe +1. Again, nothing is happening this year, but if you look into the history and the efforts made in last few years, we believe next 3 to 4 years, the manufacturing exports is something to watch out for. We have some MNCs which are already increasing capacity in India to make India a second base for manufacturing exports. So I think that's something looking out.
Anand, this textile sector was totally ignored. Then many people jumped onto the bandwagon. How much of that is all? I think you'll have a couple of stocks, Vardhaman Textiles in there. Do you believe that there is still room for upside out here?
So again, structurally, China is slowing down. Structurally, the share of China in the global textile export is reducing, but the benefits were not accruing to India. Benefits were accruing to Vietnam, to Bangladesh, and to that extent, the opportunity is there. It's just that India yet has not captured it. I think we've been tracking this sector for very, very long. We've been also owning this sector for a while, and to that extent, India has an advantage when it comes to cotton value chain. Albeit the last year had been a very different year, but nevertheless, over the last many years, India has survived the Chinese competition on cotton front very well. So I think we have a right to win. Opportunity is also there. It is for the individual companies to, make investments and make the most of that opportunity.
The other one is, VRL Logistics, Anand. That's again a play on the manufacturing theme, indirect kind of play. Yeah.
So if you see, when manufacturing suffered, a lot of other sectors also sort of suffered. Utilities for that matter. We did. So of late now we are seeing growth in electricity consumption also. So our portfolios, if you see, they have manufacturing, but there are a lot of manufacturing allied industries like capital goods, industrial products, utilities, logistics, even the corporate banks. They all are going to participate if we were to say that what we believe that manufacturing should pick up from here, not only for the domestic import substitution, but even the manufacturing exports. I think India can have a few years where even a decade, when the manufacturing can do well, and then all of these allied industries should also benefit as they have suffered in last decade because manufacturing didn't do that.
Okay, all right, Anand, we'll leave it there. Have a good weekend. Thank you very much for joining us, and we'll speak to you soon again. Thanks indeed. Well, the market is not doing very much differently. It's back down. There was a bit of a 20-25 point recovery, but that's been sold into. Nifty is down about 85 points. We slip into a break, but here's a quick programming note. Our weekend special editors roundtable comes up at 4:30 later today. Here's a sneak preview of the themes we're going to touch base upon. We'll put the spotlight on Indian growth stocks. This is what I was talking about earlier at the beginning of the closing bell. These are stocks where we are seeing earnings cuts. Now, the big macro story is not too positive. Many believe that the era of ultra-low interest rates is firmly behind us. We'll see more orthodoxy as far as monetary policy is concerned. What will it do to P multiples, which are still far higher compared to earlier averages? We'll get a quick look at this via an explainer. Siemens has gained 10% this week after the company backed its largest railway order of 26,000 crore rupees. Nimesh gets us a deep dive on the massive opportunity in the railway capex sector and who can be some of the big beneficiaries.
And this week, we had earnings coming out from Mphasis, Persistent, L&T Technology, Coforge, Cyient. Post-market hours, LTI Mindtree will also report numbers, basically the entire mid-cap IT basket. Now, the key takeaway is that the performance was very diverse. Coforge, Persistent beat, but on the other hand, L&T Tech and Mphasis missed street expectations. Compare this with the large-cap IT companies which clocked in a consistent performance. So we'll get you a quick explainer on why the mid-cap IT companies have reported a divergent performance, why things have been more selective for them versus the large cap. And with the union budget upon us, what are the key things to watch and which are the sectors that can benefit? We'll find out on the show, so don't forget to tune in into CNBC TV18 at 4:30 p.m.
Welcome back to Closing Bell. We are coming to you live from the CNBC TV18 Motilal Oswal newsroom. Well, it's that time of the day when we get in Nimesh on D Street Chatter. Nimesh, tell us how you're reading market setup. I mean, we almost went to around 18,000, but we bounced off a little bit from there.
Nigel, it looks like another week of consolidation. We saw it last week as well. Even this week, we've been trading in a very narrow range between 18,000 to 18,200. So again, 1700 is acting as a very strong support, but 18,300 is acting as a very strong resistance as well. So that's the theme for the second consecutive week. In terms of performance and in terms of flows, I guess financials stand out, but within financials, this week belong to the HDFC twins. So there is diverse flows in the financials as well, some of the profit booking in the private names and the money shifting to the HDFC twins. That's the broad trend as far as flows are concerned. In today's trade, again, it's a mixed day in terms of flows, but it clearly stands out. So there's buying in financials and selling on the other side in the consumer names. So the Lever, Godrej Consumer, all are getting sold into. Asian Paints also seeing some bit of selling pressure. So that's overall as far as flows are concerned. I guess Monday will be very crucial because we have some large index heavyweights reporting numbers this weekend. So that will have an impact on the Nifty, irrespective of what the global markets are. So that's going to track. But I guess it's a consolidating kind of a week. Not much happening in terms of the only, I guess for this week, the takeaway from flows point of view is that the selling pressure has lowered a bit from the larger FI. So that's the key takeaway. But broadly, we're still in that range and earnings are going to dominate the next week as well.
Okay, all right. So a bit of a range, consolidation mode, but individual stocks you're picking up a lot. Tell us what.
Okay, so in terms of individual names, the first stock on my list today is Coforge. That stock is buzzing in trade after relatively a better set of numbers, but now the feedback is watch out for a large block in Coforge very soon. So that's something to track going forward. That's the first one. The second stock is Indiabull Real Estate. After a very long time, some bit of a small buying traction is back from larger FIs is what I understand. So for the last couple of days, the delivery volumes are quite high. And I guess for Indiabull Real Estate, the big trigger will be the final NCLT merger approval, which is likely to be in the first week of February. So that's something to track in Indiabull Real Estate. And the last is both Tata Steel and Zomato. Both are, I understand there's going to be limit buy orders in both the stocks in today's trade. So expect the delivery volumes to be quite high. But there is a bit of buying interest back in both Tata Steel as well as in Zomato from larger FIs.
Okay, all right. That's an interesting list. I mean, that bit on Coforge is interesting, right? I mean, the management was so gung-ho, confident, and now there is, Nimesh is telling us that there is, perhaps a buzz of a block, etc. Stocks come off sharply. I mean, it was at one point up 9%. So it's some 5.5%, 6% off the day's high. That's big. 4104 on Coforge
The street is going to constantly speculate if it's Bearings. Now, Bearings is the promoter entity of Coforge. Their stake a couple of years back was 70%. They've done a couple of stake sales and brought it down to 40%. But that fear about when next the Bearings stake sale continues, we don't know who the entity is. Nimesh also is not indicated, but I think that fear is going to be there.
Nigel actually asked the management in the morning about Bearing, and of course they said that we hope that they stay with us for a long time. And of course, I mean, that's to be expected. But we'll see. That's an interesting one. Mitesh is with us with what he thinks he should do now. The market is down 76, not very different from when we spoke earlier at 2:30, Mitesh. Anything new?
Prashant, nothing new on the index, but I think, my sense is that slight dip on the hourly and the half-hourly indicator suggests that we should be heading now towards the lower end of the range. So kind of reduce our long exposure and exploring, and finding out and taking trades on more on the negative side. So I have a sell or STBT on Deepak Nitrate. I think that's a stock which is broken down. That's a sell with a stop at about levels of 1910 and a target of around 1840 is what I would look on the upside, on the downside. While Coal India is a BTST, I think that still remains a good stock showing signs of some uptrend. So BTST here. Keep a stop just around levels of 224 and a target of 232 for tomorrow, maybe max day after.
Thank you, Mitesh, for that. Big boy, Reliance Industries will be reporting Q3 numbers today. It typically comes out around 7:15, 7:30 p.m. The stock is sold off ahead of earnings. It's down 1% today. In the last 1 year as well, the stock has given no return. It's down 1.5%. So it's not done anything in the last 1 year. But what we should watch in the Q3 earnings, Sonia standing by at the big wall. Sonia.
Well, Reliance is all set to report their numbers. If you take a look at the stock performance, the stock has been absolutely flat in the last 12 months. In fact, the stock is down 16% below its 52-week highs, perhaps because of the lack of any tariff hikes in the last 1 year in the telecom industry. Now, let's take a look at the estimates for Reliance Industries. This time, it's expected to be a mixed bag. There's a quarter-on-quarter improvement in the refining margins, and that will offset the weaker petchem business for Reliance Industries. In fact, the improvement in domestic gas prices is also something that will offset the weaker petchem business. Singapore gross refining margins, just to put it on board, have contracted further to about $6.2 a barrel in the quarter gone by, and that is led by a decline that we've seen in gasoline as well as diesel cracks. Now, the strength in refining will offset the weakness in petchem, and that will lead to the EBITDA growth on a consolidated basis being quite muted. For Reliance Jio as well, we're expecting a bit of a slowdown in terms of the subscriber additions. Retail could also see a bit of a slowdown. So let's get you some numbers. For the Jio business, we're expecting just a 6 million addition to the subscribers compared to 7.8 million that they added last quarter. If you look at the estimates in terms of average revenue per user as well, hardly any growth, about a 1.3% growth compared to last quarter at 179.5 rupees. Now let's move on to the retail business. There's definitely some moderation that we're seeing in underlying growth because of the slowdown in the middle income discretionary consumption, and that will hit earnings. In terms of a growth for the retail business, we're going with a 12% quarter-on-quarter growth on the top line at about 46,600 crores. Let's put all of this together. For the consolidated business for Reliance, expect no growth on the top line. 2.31 lakh crores is what we're looking at, very similar to what we saw last quarter. On the EBITDA, a single-digit growth of around 7% is what we're looking at 33,430 odd crores, and the profits will see a growth of around 15 odd percent. Now, a couple of key monitorables. There is a big expense or investment of 75,000 crores that Reliance has announced in the new energy business. Further clarity on that is something that the street will closely watch out for in this quarter's earnings. Any growth in terms of the retail store addition will also be keenly watched. But I think more importantly, any pricing action in telecom. As I said, there's been no tariff hike since December of 2021, and hence that will be closely awaited.
Well, we wait by for those set of numbers. Sonia, thanks a lot for that. Well, JSW Steel as well will be reporting its numbers in the next half hour, Rod. And in terms of expectations, on the top line, we're working with a growth of close to around 7%. EBITDA should come down by close to around 50%. So on a year-on-year basis, they look weak. Margins as well will compress. But the important part to note is that on a sequential basis, there'll be a bit of an improvement. How does that come about? Well, the average utilization levels have improved. We already have the disclosure from the management. Steel prices, yes, they'll be lower on a year-on-year basis, as well as on a sequential basis, they'll be mildly lower. But margins will improve. How is that? Because volumes are higher. Coking coal costs will reflect, which are lower. It's not integrated, so that's good news because iron ore cost as well was a little bit lower. And Bhushan Power, that's the acquired asset, as well as JSW Coated Steel, both of them will break even. Remember, say, the previous quarter, both of them reported EBITDA loss. Overseas subsidiaries will continue to struggle. The crucial number that you're looking out is the EBITDA per ton for the domestic operations of the India business, standalone business. 7,900 is what we're working with, and as that graph suggests, it'll be a good improvement on a sequential basis, though sharply lower on a year-on-year basis. Well, we have Amrish Paliga who joins us as well. Amrish, JSW Steel, we'll wait by for the numbers and we'll chat about that. But normally, whenever you join us, you have that one stock that you're looking at. I believe CDSL is on your list.
Exactly. Good afternoon, Nigel. CDSL is a stock. In fact, NSDL enjoyed the #1 spot in terms of demat accounts pre-COVID, but CDSL overtook NSDL and became the #1 player in October 2020, and now has more than 70% market share with, of over 10 crore accounts. So they have more than 7 crore accounts with them. The stock multiplied 8x from a low of 200 in 2020 to about 1,600 in January last year, which normally happens when a stock has been discovered from an underperformer to becoming a leader. Now, in the last 12 months, we have seen additions to DP accounts have moderated, whereas analysts continue to expect a really high growth. So it's quite natural to witness the stock correcting. Now, the expectations, I believe, should also normalize. However, our investor universe is still small. It's about 7% of the population, which actually gives a decent opportunity if the markets continue to do well. And insurance dematerialization also offers a good revenue opportunity going ahead. And this, I think, should play out in FY24. And like NSDL, there's also an added focus now on institutional business by CDSL. So I'm projecting an EPS of about 28 for FY24. And with 140 rupees per share cash lying in the books, my target is about 1260.
Okay, that's about CDSL. Tomorrow is also going to be an important day in terms of earnings. You've got ICICI Bank, you've got SBI Life Insurance, Ultratech Cement, IDFC First Bank. So let's talk about some of these. ICICI Bank, will it be able to catch up its recent underperformance versus HDFC Bank? We'll find out when the numbers come. To prep us for it, Abhishek joins it. Abhishek.
Well, Rima, as you mentioned, this week, surprisingly, after many quarters, ICICI Bank has underperformed after SDFC Bank results. So SDFC Bank on a week-on-week basis is up 4% versus a flat or negative return on ICICI Bank. Coming on to the numbers, the NII growth is expected to be the best in 7 years. The key things to watch will be the loan growth is expected to be more than 21% YOY and about 5% quarter-on-quarter as per Phillip Capital. Now, provisions do decline on a sequential basis given the fact that asset quality may remain stable or improve. Net interest margin to improve about 4 to 5 basis points is Phillip Capital's estimate on net interest margin improvement. Slippages of formation of bad loans, that is expected at 4,500 crore by Phillip Capital. This compares to around 4,366 crore in the previous quarter. Asset quality, as I mentioned, expected to remain stable. Watch out for commentary from management on loan growth going ahead. So movement of two key numbers will be seen closely. Watch list, which is around 7,600 crores, and restructured book around 6,700 crores. How they improve or deteriorate, that will be seen closely. Our poll suggests NII growth of 27.7% YOY and about 5.7% sequentially. We are working with a profit growth of nearly 31% YOY and about 7% sequentially. Back to you.
Abhishek, thanks very much for that. Ambrish is with us. There's 5 minutes to close. We'll take a break and back with Ambrish when we return. Okay, just sort of racing down to close. Ambrish, apart from CDSL, which you explained well, any of the other sort of stocks which are seeing cracks today sort of interests you on the back of earnings? We've seen a fair bit.
No, I would probably talk on ICICI Bank, which will come out with the earnings. I believe this could be the last quarter of higher NIMs, as I think from next quarter onwards, we could see the higher interest rates on deposits that will play out. And because of which possibly, post these earnings, we could see the stock moving to 900 levels or so. And that should be utilized by people to, in fact, book out than to buy fresh.
Okay. Thank you very much, Ambrish, for joining in. Good speaking with you as always. Mitesh, thank you very much for joining us. And we'll see both of you back next week. We're going to end down 85 points, so 0.5% lower. For the week, though, the market comes up with a small gain of 1/3% on the Nifty. That is 70 points Friday to Friday, basically. With the Bank Nifty ends today with a 0.5% gain, so there was outperformance there for the week. The Bank Nifty, though, is up only 0.3%. And let's just look at the mid-cap and the small-cap part of the market. That was under pressure. Almost 0.8, 0.9% lower on the mid-cap index today. Similar for the week as well. And I think for the small-cap index, it was a 0.6% cut that we had in trade. Of course, lots of these, consumer names came under a fair bit of selling that we saw. Rima.
Hi, the top two Nifty losers were the consumer names HUL and Asian Paints, down 4% and 3% respectively, followed closely by Nestle, down 2.5%. JSW Steel subdued ahead of earnings, which will come out in about 30 minutes to 1 hour. Bajaj Finance saw a sharp correction through the course of the trading session. On the gaining side, Coal India higher for the third day in a row, HDFC Bank, HDFC Solid moves coming through for both these names. On Monday, HDFC Bank corrected post numbers, but after that, it's just been one way up. The mid-caps underperformed today. The mid-cap index was down 0.8%. But, you had names like, Emphasis, L&T Technology post their numbers, seeing a very sharp correction. You also had rallies under pressure. Well, the bell has gone. The Nifty's ended above 18,000, but it's a down day for our markets. The Nifty ends lower with a cut of close to about 80-odd points. The sensex is down 240 points. For the week so far, for this week itself, you've got the Nifty gaining close to about 0.4%. It's a wrap on Closing Bell. Our Friday special, Smart Money, comes up next.